everyone, it's me, Marcus Warren, financial planner, tax enrolled agent, and author of the Tax and Retirement Playbooks. So did you hear GameStop went viral? So I wanted to do a quick video about the market frenzy that you've probably been seeing in the headlines. So buckle up. It's a tad bit complicated. So what is GameStop and why does anyone and everyone care? Well, GameStop is a brick and mortar video game chain that hit hard times during the pandemic. Like many distressed companies, it was targeted by short sellers betting that the stock's price would go down. Basically, short sellers do the opposite of most investors. They try to make money when the stock price falls, they borrow shares from their brokerage for a fee, they immediately sell them, and they plan to buy them back later at a lower price when the price falls. Shorting is a strategy used by certain types of hedge funds. All right, so what's a short squeeze? Now, shorting stocks is risky since any positive news or interest in a company can drive the stock's price up. When short sellers bet wrong and a stock's price rises, they can be forced to buy shares at higher prices to cover their losses, or they have to pony up more collateral. A short squeeze happens when short sellers scramble to buy shares to cover their positions when the stock price is rising. The more investors who buy and hold those shares, the harder it is for short sellers to find shares to buy, exposing them to potentially huge losses. Are you with me so far? All right, so where does Reddit come in? So after it became clear that short sellers were betting on GameStop's demise, the popular company became the focus of amateur traders on the popular Wall Street Bets forum on Reddit, which is a popular community of chat rooms and forums. By banding together and coordinating buying activity, these small-time traders boosted the stock's price far above what the company's financial fundamentals support, putting pressure on the hedge funds betting the other way. And so the stock went viral. But why? Well, social media chatter, free trading apps like Robinhood, the bull market that we're in, new investors with time on their hands equal frenzy. But is this illegal? No, that's a stretch. These armchair traders are egging each other into speculative bets, but I don't think it rises to the level of illegal market manipulation. However, regulators might feel differently. Now, is it bad for markets? The battle between gleeful amateurs pushing prices up and hedge funds scrambling to force prices down has led to some of the highest volume trading days on record, and it cost short sellers billions of dollars. So is this David versus Goliath? I don't think the GameStop bubble is just about greed or boredom or euphoria. I see a powerful narrative at play. I think a lot of these small traders are angry at the perception that all-powerful Wall Street is pulling strings using their connections to hurt mom-and-pop investors. They see this as an opportunity to stick it to the big money pros by using their own strategies against them. It's new school versus old school, rebels versus the empire, Bueller versus Principal Rooney, Reddit versus CNBC. So should you be investing in GameStop? No. GameStop stock is massively inflated and trading has been halted multiple times because of its meteoric rise. At this point, it looks like folks are piling in just to say that they were there. Now, when the bubble burst, it'll be a rush to sell and many GameStop holders will end up losing most of their investment. It might already be happening by the time you see this video. Now, we've seen frenzies like this many times before. Tulip mania in the 1630s, the Nifty 50 in the 1970s, the dot-coms in the 1990s, Bitcoin's multiple bubbles over the last decade. We'll probably see more in the future. But why are people angry at Robinhood? Now, amidst this buying frenzy, Robinhood and other popular brokerage platforms suddenly restricted trading on several red-hot stocks, including GameStop. Protests erupted from investors, many market pros, well, not the short sellers, obviously, lawmakers, and more. Now, did Robinhood halt trading to appease big investors at the expense of the small investors? Did they do it to protect markets from manipulation and liquidity problems? Look, I dislike the idea that a broker can just shut down trading in a security. I think it opens the door to situations where platforms prioritize one investor over another, and that is a massive conflict of interest. I'm frustrated on behalf of everyone else affected by brokerage outages and difficulty trading. But frankly, it's pretty wild that a bunch of regular folks with small trading accounts can bring massive institutional investors to their knees. All right, so what are the implications of this frenzy? Now, there's no predicting the future, obviously, but I think a few things are likely. Most bubbles end naturally when the euphoria turns to panic. Folks start selling and the price crashes. However, it is also possible that regulators will step in if they think that there's a risk to the markets or they see too many investors getting hurt. I think this ride is going to end in tears for many folks caught up in it. But I'm not sure who's going to be crying the hardest. I do think markets could see some wild swings and pull back from their frothy highs, but I don't see major risk yet. But I think we'll be left with some pressing questions once the dust settles. Will social media traders continue to drive big market moves? Do platforms have the right to arbitrarily decide that customers can't trade? Are coordinated moves by small investors a danger to the market? And should regulators be watching hedge funds more closely? Now, this is an evolving situation, so I'm keeping a close eye on markets to see what might happen next. All right, you have questions, you have thoughts, please hit reply and let me know. Until next time.